Hey everybody, welcome back. It is Wes with Pikes Peak Trades. My first couple videos to start the year in 2023 have mainly focused on some shorter term counts, giving you guys what I typically go through in creating a trading plan, and then mainly focusing on the 15-minute chart, as that's my primary chart that I look for trading both day and swing. Obviously, entries and exits get down to the smaller time frames. But what I wanted to do in this video is I wanted to back up a little bit, zoom out, and show you kind of what I'm looking at as my primary views for the market in the bigger degree Elliott wave counts. So we're going to start here with the SPX quarterly chart, and I think the quarterly close coming up at the end of March of this year is going to be absolutely essential. And I've circled some areas that have taken us back through the last two major bear markets that have not been just part of a cyclical bear. They've actually been a secular bear where that has been the predominant trend for multiple years. And if we are in fact in that, I think we're going to see a quarterly failure below this 8 EMA again. Now, you're going to notice that January so far is off to a great start, and price right now is about 75 SPX points above that quarterly 8 EMA, which I think is just really important for distinguishing long-term trends. If the quarter closes above that EMA, then I really think we have a market position that is much more like the fall of 2011 into the winter months of 2011 and 2012. I'm going to show you that on IWM here in just a little bit. And in that case, we're looking at a primary 2 low coming off a significant cycle low. Now, I have the great financial crisis connected here in a secular bear all the way through the dot-com crash in SPX. Now that's going to look a little bit different in the Qs because the Qs did not make a lower low in the great financial crisis, so their count has to be different. I have a super cycle low for the main tech ETF. That makes sense coming through the dot-com crash, then a higher low as a cycle. And then I have here the COVID crash matching the degree of that in the great financial crisis. The reason why SPX is going to count differently is because how massively financials were hit in the GFC. So I have that entire completion here as a expanded flat correction down to a higher degree. But that still places the same primary 1-2 pattern coming up off those lows. Even if it was QQQ, you'll see IWM shares that similarity. Okay, so my broad point here is if we can close this first quarter of 2023 above this 8 EMA, unlike what happened in the actual secular bear legs in the dot-com and the GFC, where you see multiple losses and closes below of that 8 quarterly EMA. That's what led to the nasty swings down in the markets during those bears. If we reverse that and come back up, I think we're looking much more like we're moving up into the start of a new primary leg. Okay, now that would certainly fly in the face of sentiment. I think it would certainly fly in the face of most talking heads, not all, and also I think most Elliott waivers. I would view right now, from what I'm following on social media, what I have access to, about 1/3 would be in my position of thinking that this is a significant, just a secular bear, not a secular move down to a new cycle low. Now, we can't get rid of that count because we don't have enough higher time frame evidence. I want to see that quarterly close, but at least so far to start the year, we have really good price action. We've got already some momentum and breadth thrusts that have happened here within the first half of January. And you're going to notice we are just poised right on significant breakouts, not only of EMA clusters, this is the SPX monthly, but also close to breaking the recent swing highs. You're going to notice, I mean, this trend line is out there for the entire world to see. We get that up and out of about 40.50, and I think we can probably put the probability that we are in fact moving up in the early stages of a new primary leg. We're going to have to bump that up. I'd give it a 4-to-1 advantage. Now, obviously, you see that we're still under it here on cash. I think we're over it on futures, but I always give cash market pricing when the big institutionals play at the casino. I always give that more weight than futures. This would be the location of the bear rejection. And if I drill down here into the fibs of that, you're going to see here, let me try to move that away from the volume shelf a little bit, right there up towards that 0.786 fib. You're going to notice SPX along with ARK-K and IWM and DIA all closed above their daily Bollinger Bands. I think we are in a technically overbought condition. We also saw NYMO close above plus 100. That's really incredibly overbought. I'm not saying that's unhealthy. It's very healthy from the bull perspective. I just think it's short-term overstretched. So what I am looking for at some point this coming week here in January is for a pullback. So I've got a couple different ways that that could happen. Since we're looking at big time frames, I did want to make sure I didn't skip IWM. And you're going to see, just like I showed with SPX, we are so close to a significant breakout. So the midline of this bull channel that I have traveling right up through a potential primary top, that would match exactly what I described in SPX, coming off the GFC, a P1, P2, coming off a cycle degree low. That I really like the matching symmetry here in small caps, a P1, P2 projecting upwards, let's say into the later part of this decade. This would have nearly a doubling in small caps. I am very, very, very much interested in the risk on look that small caps are showing. Extremely healthy for the markets if the smallies can get out in front. And they are not far here from a significant monthly breakout. If we see January close with IWM at 190 or above, we're not only going to have that EMA capture, we're going to have that mid-channel capture. And I think we're then going to see most likely SPX break that downtrend that I showed you. Now on the weekly, I think the weekly with small caps does a great job of showing you, though, just how much more work we have to do. In the work that I do with the markets, I give horizontal pivots actually more significant importance for my breakout work than I do diagonals. And so you're going to see on all time frames that I chart, I'm constantly charting horizontal pivots. Here you're going to see that overbought look temporarily on the NYMO. I think we've got a really kind of cool classical pattern of a double cup that I think is kind of begging for a handle. And so I have one possibility, like I showed you on the SPX daily, that we're looking at a minute 2. So that's going to be the corrective move against the lows that we saw at the end of December. Now into the short term, and this is kind of where I would bring into my trading plan here for you as well. Two possibilities, because I'm not exactly sure if all of the major ETFs that I track have put in a full 5 leg swing, a full 5 impulse into that minute one, followed by that correction that I talked about against the late December lows, or if we're just looking at a 3 and a 4. But I think either way, what I kind of want to show, and this is in the spirit of Elliott Wave here, what I think is a 5th wave extension on that move that began following the CPI release on Tuesday. So here we have that looking for a sharp retracement. Now, the reason why I want to show you IWM is in the same degree, I have 2 as a large expanded flat, which means I think we could expect something very different from 4. I think this could be a very sharp zigzag right up here against the channeling. And so I'm kind of wondering if we're going to see a quick move, maybe even a spike up open all the way back down to that channel. And so my primary look here early in the week is actually going to be from the short side. We still have a gap to fill right here. That's just above 188. I'm going to show you the short-term SPX as well. I think we could make a challenge up here towards that 420 pivot. That's about 403 on SPY, and then look for that sharp potential ABC down. On the Qs, that gap is actually much, much higher. That's all the way up about 286, but I kind of have some diagonal and fib resistance right around 282, 283. So if we spike up and then we lose this 280 pivot, I think that could usher in that zigzag move that I'm talking about. Okay, so I wanted to combine more of that long-term look with the shorter-term trade plan so you can see kind of what I'm looking at. Just to give you back to that broad view, we closed March strong above that 8 EMA, and I think we've sealed those bear market lows. We reject here, and we close through March under let's say 3850 to 3800. We increase the probability that we are actually looking here, not just at a cyclical bear, but at a secular bear, more on the degree of what we saw in 01 to 03 and 07 to 09. So great start for the bull counts to start this year, but a lot left to be decided. We've got about 2.5 more months of work before we can drill that down. And again, I'll leave you with one short-term look. We're going to see what happens here. I'm certainly not going to chase a gap up open Tuesday into pivot and previous reversal zones. I'm going to be looking to buy a pullback here at some point early to midweek. All right, gang. So hope you're enjoying the content. Have a wonderful start to the week, and I'll catch up with you guys again over the next weekend.